my outlook right now is the idea that, as you have told us on this show, over the next 1 to 3 years, things are going to get weird, right? Like we're headed into like a weird recession, unlike anything that you and I have like lived through, because we weren't alive last time that inflation was a real big problem. You know, combine that with interconnectivity of the world and other countries doing other things and crypto and all these other things that are happening.
Right.
We believe that in the next 1 to 3 years, real estate prices are likely going to stay at least stable or go up, but there is a chance that maybe it dips at some point in the next one or 2 years. That's not beyond the realm of reason. But we are pretty sure that in the next 5 years, real estate values will have gone up.
Yeah, I'd say even in 3 years, I feel very confident real estate values will be higher than they are today.
Cool. We're also pretty confident that over the next 2 years, interest rates are going to do some weird stuff too. They're going to go up and they're going to like oscillate and whatever. And eventually they're going to have to come back down, probably in a reasonable window of those 5 years.
Yeah, it's very reasonable to assume that at some point over the next 2 years, your interest rates are going to be lower than what they are right now. And who knows what happens in between now and then.
Correct. So if we're looking at an environment where prices of homes are going to go up, and in the future, interest rates are going to go down, and I'm looking at my money right now, and I can either put it in a stock market that's going to do even weirder things because of all the stuff that's happening, and I have no idea what's going to happen in the next 2 years, in bonds that are not paying me as much as inflation, right? Keeping it in a bank account, which who knows when the next bank run is going to be, right? I literally just bought a little bit of Bitcoin to hedge for that today. We know this.
Yeah.
Right? Or buying gold, which, you know, has very little utilitarian value, but it is a store of value, burying it under my house. I think it's a very attractive proposition to think, if I have money that I want to invest, or I have money in the market right now, putting that into rental properties that are cash flowing, that in the short term are not going to pain me, right? In the short term, I'm not going to lose sleep over my cash flowing rental property while the world does weird stuff.
Right.
Knowing that in the next 5 to 10 years, it's very likely that homes will have appreciated, my debt will have been paid down some, and interest rates are going to end up falling. And by the time that the interest rates fall and I'm going to want to get in the game, not only would I have lost out on that appreciation and that debt pay down, but once interest rates falls, prices go up immediately.
That's right.
And everybody's going to be rushing to it. So I want to be sitting tight with this asset that I am, you know, my 3 assets that I've bought, that I'm going to then very likely be able to refinance in the next 5 to 10 years. And like Hervé did, go get me some more homes for free.
Yeah. Well, I think I love where you're going with that thought path, because it's like, you know, this question that we keep asking on the show, if not rental properties, where are you putting your money that's going to help you sleep well at night right now? And there's just not very many places. But let's separate the two opportunities that you have right now. We started talking about leverage at the purchase decision. So when you're talking about where do you think people should put their money, or where would you put your own money at a purchase decision, that's really where that decision comes in, is whether to use leverage or not. Like, for example, let's say that you had $225,000 and you were deciding what to do with it. And you could either purchase one JWB rental property in cash, or you could use financing, right? And you could buy, 3 JWB rental properties, right? And then the other alternative is if you could just buy one finance property and then just keep the rest of it in real cash, like in a bank. So you really have 3 opportunities there.
Got it. So the opportunities is all my cash into one property, use my cash to leverage it and buy 3 properties, or, one property and then save some cash.
Right? Well, the question is, if you made the decision to only put, let's call it $75,000, one down payment to buy with financing in place, what are you doing with the rest of it? Stocks, on average, when when eventually, most likely we get to a recession, an average of the last 12 recessions has been a 30% decrease in the S&P 500. So that's not making me feel good about keeping that money in the stock market.
Yeah.
Bonds right now.
Yeah. That doesn't take the sleep well at night.
Doesn't sleep well at night. Yeah. Bonds, you might sleep a little bit better at night, but at the end of the day, you're just losing because bonds are not keeping up with inflation. And they certainly don't have any upside. So you might be sleeping a little bit better at night, but you're not advancing towards your financial goals. And then investors used to have just an option of just keeping it on the sidelines, putting it in the bank. Well, that's really bad. If I keep the recent bank challenges out of this, because I don't want to pile onto that too much. I'm not concerned about a bank run. I'm not concerned about, our banks failing in mass. Yep. It certainly caused people to think a little bit more about that lately. But investors used to have this option of just sitting on the sidelines and keeping it in cash. Mm-hmm. But when inflation is still so high like it is right now, that's losing 6% on your money every single year. So that's really you going into an investment decision saying, I'm going to lose 6%. Not many people sleep well at night. Correct. Thinking they're going to lose 6%.
Putting your money in a bank account that returns negative 6%.
Yeah, that's exactly what the decision to sit in cash is. So that's where this idea of leverage and diversification, you can do that by putting that same amount of money out and diversifying that into 3 properties versus 1. This is where you ask yourself, if I'm not putting it into an asset that performs consistently like rental properties, where are you? And I don't have a good answer for that one.
Yeah.
Now on the flip side,
yep.
Now let's fast forward. You've owned an asset for 5 years or 10 years, and you may or may not know that you have significant equity built up in your asset, but interest rates right now are really high. That's a different decision, right? And many investors are struggling with this because of recency bias, right? We're all a little bit burned because we saw the opportunity to refinance, a year ago with interest rates being so low. Now interest rates are higher. And I think where a lot of people are struggling is, does it still make sense to refinance? When would it make sense? When would it not make sense to refinance? Yeah. So maybe we should just jump into that a little bit.
Yeah. I'm in, man. Like what I'm hearing you saying is like, man, if I like Hervé did, right? Like if I bought property 6 years ago, and then a year and a half ago was like, I'm going to take this equity and I'm going to refinance it. Well, you're looking at properties that you bought 6 years ago at a higher interest rate that now have equity and now have a lower interest rate. No brainer. Right. Pull it out, put that money to work. On the flip side, there could be somebody that bought properties 4 years ago, have not refinanced, mm-hmm. have a ton of equity in the property, mm-hmm. have some debt pay down, but now they're going to go refinance at a rate that's higher mm-hmm. than the original loan that they got. May still make sense. They may be refinancing at 7% right now to get this 14%, but you're saying it's just not going to feel as good, even though the numbers pencil out.
The numbers may pencil out, they may not, but it's definitely not going to feel as good. It doesn't
feel as good.
And I think as investors, we need to get over the emotional component as much as possible. I mean, flat out right now, people are saying interest rates are so high. I mean, the interest rates right now are lower than when I started to invest. When I bought those first 40 rental properties, my interest rates were 7.5% on my loans. And I was excited about building assets that perform for all 5 profit centers. So I think we need to try to get over this emotional reaction we have to interest rates going up so much and just realize that, the debt that we have access to in this country is a huge asset versus other countries. But it may pencil out and may not pencil out. So that's really what I wanted to share with all of you. If you are in that position, when would it make sense? Still, if you can get over the emotional component, when would it make sense to refinance and pull equity out? And when would it not? Whenever you go and you refinance a property, there's a certain amount of pain that you have to go through to get a loan. So like, to me, if I'm thinking about, is it worth it to refinance? There has to be, a significant return on that investment to do it. That's worth it for me. But I still think that it absolutely could make sense. Here's a couple of examples. Let's say that you have $100,000 of equity in your home. So you bought it whenever. And, call it 5-10 years ago, something like that. And you have $100,000 of equity that you could pull out from a refinance. Well, You're going to have some costs that come along with the refinance. So you might have expenses of maybe $3,000 of just closing costs that come along with it. And so you've got $100,000 of equity you'd pull out. Well, we're assuming if you pull that $100,000 of equity out, you would turn that into another really smart investment. And I'll just keep it simple. Let's assume that you were able to earn 10% of a return.
Private lending style.
Private lending, right? Yeah. You know, you'd earn more than that with a rental property, but we'll just keep it simple. Well, if you want to run the numbers for it, you've got that $100,000 that's coming out, but now you're going to borrow that at, let's call it a 7% interest rate. Okay. I'm just going to be conservative here. You're going to lend it out at 10%. So you're going to make $3,000 on the spread there over a year. And so if you could pull $100,000 out, you'd make 3% on the spread, $3,000 you would make, but your costs going into it were going to be $3,000 to do the loan. So that's kind of like you'd break even in the first year. Now you'd probably keep that loan in place. Let's say that you didn't refinance for 2 years. So now at the end of 2 years, you know, you made $3,000 on that spread. You actually made $6,000, but you had those $3,000 of origination costs. So if you had $100,000, to me, that's kind of like break even. Is it worth my time, your time to make an extra, maybe break even to somewhere around $3,000 before you go and refinance again and get that rate down? Probably not worth it. For me, you know, probably not worth it for you.
Because getting loans from a bank is kind of a pain
in the butt, you know, that doesn't really make sense. But if that was $1 million in equity you were sitting on, and, you know, I think your point about what happens when interest rates go down again, how home values tend to go up again. If you're sitting on $1 million right now and you have the opportunity to lock in your cost basis, your purchase price at a lower cost today than you probably will in 3 years. Well, I think that value can change. That equation can change. You know, you start adding some zeros to it. And now instead of you making $3,000, you know, after a 2-year span, we'll go through the numbers again, right? You borrow $1 million, you know, you make 10% on that. And you have, you know, $100,000 that you've earned from your investment. You had $70,000 in costs that you paid on your loan and debt costs. So your 7% turns into $70,000. And now you've got a $30,000 spread that you made year one. It's
different.
And you spent $3,000 to get that loan. So now you made $27,000 in year one. You know, that's probably worth it for me. It's worth my time. It's worth your time, right? And then the second year, you probably make another $30,000 as well. So you might have made $57,000. And that's why it might make sense to do that. It's really dependent on the amount of equity that you have to pull out and how long you think until you probably will refinance later on is when it might make sense to do that.
Got it.